Hello friends, today we'll take the RTP SFM May 2023 part 2. In the previous part 1 we have covered the first 7 questions. So now today we are going to cover the remaining questions. So please keep the RTP in front of you and you can download the RTP from our website vino.in. In vino.in, please go to website, free resource section, you can download the RTP. Okay, so should we start now? Should we start now? Say yes. So question number 8 should be in front of you. RTP SFM May 2023. Very important question. A new question. Something new. XYZ has taken a 6-month loan. The first thing you underline 6-month loan from its foreign collaborator for USD 2 million. This company has taken loan of 2 million US dollar and the maturity of the loan is after 6 months. Interest is payable on maturity at LIBOR plus 1%. Interest is payable at LIBOR plus 1%. So whatever is the LIBOR rate, 1% premium will be paid. Hello to everybody, those who have joined just now. Mr. Mohammed, hello. Spot rate is given, the following spot rate is given rupee per USD and the 6-month forward rate is given rupee per USD. What is the interest rate in USA? The 6-month LIBOR for USD is 2%. This is 2% per annum. Even if per annum is not written, all the rates are in per annum term, which means if you borrow for 6 months, the rate of interest is 2% per annum. 6-month interest rate in India is 6%. 6-month LIBOR for INR is 6%. This is also per annum. So this is one mistake where student can make a mistake. They take directly 2 and 6. But please remember, all rates given are per annum. All rates given are per annum rates. You are required to calculate rupee requirement if forward cover is taken. So in case if we take forward cover, we will have to pay at this rate after 6 months. So basically you have to find out dollar amount payable multiplied by this forward rate of 68.4575. So this is a very easy question. A similar question was asked many years ago, which had this first part. Now what they have done in this RTP, they have added one more part, advise the company on the forward cover. That is whether the company should take forward cover or not. Then next is, what will be your opinion if the spot rate of INR per USD 68.4275? The spot rate is 68.4275. Will you go for forward cover or not? Okay. So let us solve this question. First question is, what is the rupee requirement if the forward cover is taken? So write down step 1, applicable interest rate for USD. Applicable interest rate for USD. This extra working note I am giving because sometimes the student make a mistake. They directly take 2%. So dear student, write down applicable interest rate for USD. LIBOR plus 1. LIBOR plus 1. That is 3%. LIBOR plus 1 3%. Now I am going to use this LIBOR plus 1 3% to solve the question. Step number 2, write down rupee requirement if forward cover is taken. Rupee requirement if the forward cover is taken. How much amount we have to pay in rupee? How much amount we have to pay in rupee if we take forward cover, if we pay as per the forward cover rate? So first write down loan. $20 lakh. Loan is $20 lakh. 2 million is $20 lakh. Second, write down interest. Second, write down interest for 6 months. Second, write down interest for 6 months. Interest for 6 months. 20 lakh into 6 by 12 into 3%. 20 lakh into 6 by 12 into 3%. That is 30,000. Check the answer, 30,000. Next, write down amount payable on maturity. Amount payable on maturity. Amount payable on maturity. A plus B, 20 lakh $30,000. 20 lakh $30,000. Forward rate write down, which is given in the problem. This is the forward rate which the bank has quoted. That means we will have to pay at this rate on maturity, 48.4575. This rate is contractual rate, that is the rate already given by the bank. Next is rupee requirement. What is the rupee requirement? Rupee requirement will be C into D. Rupee requirement is C into D. Rupee requirement is C into D. Multiply C into D. Come on. The answer is 13 crore 89 lakh 68,725. 13 crore 89 lakh 68,725. Check the answer is whether it is right or not. Now there is another part of this question. The other part of the question is, which is the new part they have added. What you have done up to the previous step 2, it was already asked in some earlier exam paper. Now they have added one additional part. Question number 8, second part, advise the company on the forward cover. Advise the company on the forward cover. Should the company take the forward cover? So when you take forward contract with the bank, we have to pay at the rate of 68.4575. We have to pay at the rate of 68.4575. But suppose we don't take forward cover, what would be the exchange rate after 6 months? What would be the exchange rate after 6 months? So we will find out what would be exchange rate after 6 months using interest rate parity theorem. What would be exchange rate after 6 months using interest rate parity theorem? If I find that the interest rate, suppose this is suppose as per IRPT it comes to 68.50, that means it is better to take forward cover because I will have to pay at a lower rate. But suppose it comes to 68.40, then it is better not to take forward cover, wait for 6 months, and as per IRPT the rate will be 68.40. So we'll have to check what would be the exchange rate after 6 months as per IRPT, because we are given interest rate in both the countries. So now write down step number 3 just to check what will be IRPT exchange rate as per IRPT. Calculation of forward rate as per IRPT. Calculation of forward rate as per IRPT. Write down the formula, already you are aware. Forward rate is equal to S into 1 plus RD by 2 upon 1 plus RF by 2. 1 plus RF by 2. So now we'll solve. This is the spot rate in the first 3 lines of the question into 1 plus in interest. In India the interest rate is 6%. In India the interest rate is 6%. 0.06 divided by 2, and in USA the interest rate is 2%. The interest rate is 2%. 1 plus 0.0 by 2. So we are going to take the base rate 6% and 2%. That 1% premium is specific to the firm, which can be different for different firm, but that LIBOR 6% is common for everybody. And why we are dividing by 2? We are dividing by 2 because it is 6 months problem. So now you will solve and give me the answer. The answer comes to, please check, 69.8845. 69.8845. 69.8845 per US dollar. And what is the forward rate bank has quoted? 68.4575. So it is better to take a forward cover because this is much lower than the exchange rate that you will get as per IRPT. So write down the conclusion for the first part. We should go with forward contract. Please write down, company should take forward cover. Company should take forward cover because IRPT rate is higher than the rate quoted by the bank. IRPT rate is higher than the rate quoted by the bank. IRPT rate is higher than the rate quoted by the bank. This is the answer of part 2. Very good question to test your understanding of IRPT and forward rate. In the third part of the question, what they have done, they said that will your answer be same if the spot rate is 68.4275. So let us check. Same thing. Again I am going to compute the forward rate as per IRPT. Again I am going to check whether it is below or above the rate quoted by the bank, and accordingly we will be able to answer. I am not writing the formula again, so write down forward rate is equal to this is the spot rate into 1.03 divided by 1.01. These two will be same, only this I am changing. So when you solve it, you are getting 69.7825. 69 or 68, let me just check, just please wait. 69.7825. 69.7825. And what was the forward rate quoted by the bank? 68.4575. Again the answer is, this is much lower. This forward rate quoted by the bank is much lower, so I will better go with forward contract with the bank. Just let me just check the calculation why it is so different. Please, you can also try. Yes, this is right. 69.7825. 69.7825. Same conclusion write down. In this case also, in this case also, in this case also, the company should not take, the company should not take, company should take, in this case also the company should take forward cover. In this case also the company should take forward cover. So that was question number 8. Very important question. Write down, very important question, 5 star. Second part you may not be able to answer in the exam if you don't go pre-prepared. Is it right? So dear student, come to question number 9. This is a repeat question. Same question they have repeated in the past also. 2-3 times they have asked this question. Question on foreign exchange management, but important. Again, if you don't practice this question before going to the exam, there can be a mistake. So good evening to everybody who has joined just now. Mr. Rishabh, Aisha. Mr. A Limited is planning to import an equipment from Japan at a cost of 3,400 lakhs yen. Same problem they have asked earlier also with the same figures. The company may avail loan at, underline, 18% per annum interest with quarterly rest. 18% per annum interest with quarterly rest. Now what is quarterly rest? Quarterly rest means quarterly compounding. So in India, if you borrow money, the interest is charged every quarter and the interest is compounded quarterly. So the formula would be, for computing future value, 1 plus r divided by 4 to the power n into 4, that is future value. I hope you have studied this in the school level mathematics classes. Now here the student make a mistake, they don't consider the interest on quarterly compounding basis with which it can import the said equipment. The company has also an offer from Osaka branch. Osaka is in Japan, of an Indian bank extending credit of 180 days at 2% per annum. So there is a big advantage of borrowing from Japan. The interest rate is 2% per annum, whereas in India interest rate is 18% per annum and with compounded quarterly against an opening an irrevocable letter of credit. Irrevocable letter of credit means it cannot be cancelled. Anyway, it will not affect your answer. The word irrevocable means non-cancellable. Additional information. Present exchange rate is 100 rupees is equal to 340 yen, and 180 days forward rate, 180 days forward rate is 100 rupee equal to 345 yen. Commission charges for letter of credit is 2% per 12 months. So 1% for 6 months. So 1% for 6 months. Advise whether the company should accept the offer. So basically you have to make a choice. Choice is borrow in India or borrow in Japan. If you borrow in India, interest will be 18% per annum. Interest 18% per annum, quarterly compounding. Okay, there is a student who has a question. Can the SFM lectures be applicable for November 24 exam? The answer is yes. You can purchase our SFM lecture applicable for November 24 exam, and whatever MTP, RTP questions will come from this date till November 24, we are going to cover on our YouTube channel. So don't worry, if you follow our YouTube channel, all the questions that will be asked in RTP, MTP and exam, We are going to take a session on that and you will be updated with that. Okay. Can you come to the question again? The other option is you can borrow in Japan. There are two costs. One is letter of commission cost, which is 2% per 12 months, and second is interest. But the third factor also we have to consider is exchange rate movement. The third factor that we have to consider is also the exchange rate movement, right? So all this will be covered, calculated, this will be calculated, and because we have to pay after 6 months, the choice will be lower of the two. If I borrow in India and if my cash outflow in rupee is lower, I will go with Indian borrowing. If I borrow in Japan and my cash outflow in rupee is lower, I will go with yen borrowing. So don't be patriotic. No patriotism. You are a businessman. Select the option which will result into lower cash outflow in rupee after 6 months. So first you write down option 1. The same question we had covered in the class also. Option 1 is borrow in India at 18% per annum. Borrow in India at 18% per annum with quarterly rest. Borrow in India at 18% per annum with quarterly rest. Underline quarterly rest means quarterly compounding. The formula for future value when it is a quarterly compounding is PV into 1 plus R to the power 1 plus R by 4 to the power N into 4. So using this formula, we will see how much amount is payable in rupee after 6 months. So in 6 months there are 2 quarters. In 6 months there are 2 quarters, so this will become 2. Okay, let us write. You'll understand better when you write. Follow my instruction, write down along with me, line by line, step by step. Institute answer sometimes is not understandable. Amount to be borrowed in INR. Amount to be borrowed in INR is 3400. 3400 is the yen value into 100 by 340. Into 100 by 340. Into 100 by 340 is 1000. 1000 in rupees in lakhs you have to borrow. Now write down B. Amount payable after 6 months. Amount payable after 6 months. Using this formula we will get 1000 into 1 plus R means rate of interest 18% divided by 4. Number of years will be 2 quarters. N will be 2 quarters. This is power 2. Why power 2? Because 6 months means quarter 1 and quarter 2. Or you can take half year into 4. If I apply the formula strictly, then also it will come to 2. Whichever way you understand. Tell me the answer. The answer is 1092.025. 1092.025. Check the answer. Now write down option 2. Accept offer from foreign branch. Accept offer from foreign branch. Accept offer from foreign branch. Right hand side amount in rupees in lakhs. So we have to make payment of letter of credit commission also. And we have to also pay to the foreign bank principal plus interest. All figures will be converted into 1 INR, and second, all figures will be considered after 6 months. To make the two answers comparable, the currency should be in rupees and the amount payable should be after 6 months. Who is going to open the letter of credit? The letter of credit will be opened by a bank in India today. It's like a guarantee given by an Indian bank to a foreign party that don't worry, my client is going to make the payment to you, and if my client does not pay, we will pay. So letter of credit commission is 2% for 12 months. So for 6 months, it will be 1000 into 2% into 6 by 12. So that comes to 10. That comes to 10 lakhs. Then write down. Now this amount will be paid today. In year 0, 10 will be paid. But all calculations we are doing after 6 months. You are going to pay this 10 lakh out of your Indian bank account or Indian bank borrowing. So we'll have to calculate the opportunity cost for 2 quarters on this 10 lakh. Otherwise we will not be able to compare a cash flow today with a cash flow at the end of 6 months. So in India, the opportunity cost of fund is 18% per annum quarterly compounding. So my interest for 2 quarters will be 10 into 1.045 to the power 2. This will give me future value minus 10. The difference will give me interest. That means we are considering opportunity cost on 10 lakh for 6 months in India. The opportunity cost of 10 lakh for 6 months in India is 0.92 lakhs. So total letter of credit cost, write down. Total letter of credit cost is 10.92. Now we are also going to repay the loan with interest at the rate of 2% per annum for 180 days. So write down repayment of yen loan at the end of 180 days. Repayment of yen loan at the end of 180 days. So this is the loan amount 3400 plus this is the interest on yen loan 3400 into 2% into 180 by 365. So kindly tell me the final figure here. Interest plus principal. Come on. 3433.53. 3433.53. 3433.53. But that is in yen. But we have to convert into rupees so that I can compare with the first answer. So now I will calculate payment in INR. If you look at the question, the forward rate is 100 rupees equal to 345 yen. So what is the equivalent amount in rupees? The equivalent amount in rupees, come on, 3433.53 into 100 by 345. So the answer is 995.23. 995.23. Total cost under yen borrowing. So if I borrow in Japan, one cost is letter of credit cost. The other outflow is repayment of loan plus interest. So this number takes care of the exchange effect also, the interest effect also. Now you add these two numbers, C plus F, C plus F, C plus E, should be C plus E. So it comes to 1006.15 yen. This is lower than the previous answer. This is lower than the previous answer. So write down advice. Advice, write down. Borrow in yen as rupee outflow is lower by, under rupee borrowing, my outflow is 1092.03. Under yen borrowing, My answer is 1006.15. So by borrowing in yen, I will save 85.88 lakhs. By borrowing in yen, we will save 85.88 lakhs. So this way the student has to write the conclusion also. Okay, this way the student will have to write the conclusion. That was question number 9. Now we'll come to question number 10. So before question number 10, I am going to tell you something important. We are conducting FR plus SFM test series for students who are appearing in May exam. Now this test series, there are 4 tests in each subject, FR and SFM, which I teach. Question paper is set by me and it will be checked by me only. Checked by me, checked by the faculty, not outsourced to intermediate student. Okay, this question will be mostly new question, not repeated from past exam. Most of the question will be new, so that there won't be you will understand that what happens when you get a new question in the exam. It will boost your confidence, it will prepare for your next exam. If I give you all the past exam question which they have already covered in the class notes, there is no surprise element. Many test series have this wrong notion that let us give them old questions only, past questions only, but that is not good for the student, because exam will have new variety of question, new type of question which are unseen in the past. So we have done that. So you can join the test series on our website www.vino.in. On the home page there is a test series section. You can take the test. You can take 1, 2, 3 or 4 tests according to your convenience. Your answer will be checked by me, and maximum 7 days you will get your answer back with lot of feedback and comments. So we'll come to question number 10 now. Write down repeat question in the exam. This time RTP has certain repeat question also, but can't help it. Let us solve. A US based company is planning to set up a subsidiary company in India, where so far it was exporting. So US company is planning to set up a subsidiary in India. Till now it was exporting to India in view of the growing demand for its product and competition from other US based company. So now it has started facing the competition from other US based company also. So it thought that it is better that we only start manufacturing in India. The initial project cost consisting of plant and machinery including installation is 490 million USD. So this is my cost, capital investment cost. The net working capital requirement are estimated at USD 60 million. Another investment requirement will be working capital of 60 million. The company follows straight line method of depreciation. Very easy. This will help you to save time. SLM. And what is your capital cost? Capital cost is 490. So while calculating depreciation, take 490. Currently the company is exporting 2 million units every year at a unit price of $90. Its variable cost is 850 USD. Underline. At present the sale is 2 million quantity. Selling price is 90, variable cost is 50. The CFO of the company is estimated the following operating cost and other data in respect of the proposed project. Now what is the benefit of this project? If located in India, the variable cost will be 30. So variable cost will be 50 earlier, 30 now. There will be a saving in variable cost. Additional cash fixed cost will be, this is additional cash fixed cost. Cash word underline will be 30 million USD, and project share of allocated fixed cost will be 3 million USD per annum based on principle of ability to share. So this you write down, not relevant. It is allocated cost. Allocated cost is not relevant. So this is given to confuse you, but this 30 million will be useful for our answer. Allocated cost will not be useful. Expected useful life is 5 years. So depreciation will be 490 divided by 5. That is approximately, check, 98. Depreciation will be 98. No salvage value. Salvage value after 5 years is 0. Production capacity of the proposed project in India will be 5 million unit, and earlier it was 2 million only. So the sales will increase by 3 million units. Estimated working capital investment for the production and sale of 2 million units through export was USD 25 million. Again, important point, when the production was in USA, the working capital requirement was 25 million USD, and as we have read above, if you manufacture in India, the working capital requirement is 60 million USD. So there will be additional working capital requirement. There will be additional working capital requirement. Who will answer what is additional working capital requirement? So we require 60 million. Now we already have 25 earlier. So if you start the project in India, you will have to put $35 million more in working capital, not 60, because 25 is already there. So I just have to increase it to 60. So I have to increase by 35. Export of the product in the coming year will decrease to 1.5 million units, provided the company does not set up subsidiary company in India in view of the presence of competing other US based companies that are in the process of setting up of their subsidiaries in India. Very good line. If I set up the plant in India, the output will be 5 million units. But if I don't set up the plant in India, in future, my export to India will be 1.5 million only, because there will be more competition in India. More US companies will set up their operations in India. So by setting up this factory in India, the company is going to benefit in future 3.5 million units. So do not compare with 2 million units because it was in the past. You have to compare with 1.5 million units because that is the future sale projection. Applicable corporate tax is 35. Just repeat, this 2 million not relevant. Required rate of return 12%. Assuming that there will be no variation in the exchange rate of two currencies and all profits will be repatriated, no withholding tax, estimated NPV of the project in India, and give your advice. So this question has no exchange rate conversion. Although it's a problem of international capital budgeting, but the problem says exchange rate will not change at all. So there is no need for conversion at any stage. And in some problem institute used to give withholding tax, no withholding tax also. So very easy question from that angle. NPV you have to find out at 12%, and these are the factors given. So what I'll do, I will divide my answer into two stages. First, I will compute incremental CFAT. First, I will compute incremental CFAT by choosing this project, by what amount my CFAT will increase, and second, I will compute incremental NPV, and if incremental NPV is positive, I will undertake this project. So if I undertake this project, my sales will be 5 million against 1.5 million. So this is the main advantage. My revenue will increase on 3.5 million units, but my variable cost will also change. Earlier my variable cost was $50 per unit. Now it will be $30 per unit. So what variable cost I was supposed to incur versus what I will incur in future, I will consider. Third is cash fixed cost we will incur 30 million, which was not there earlier. Fourth, we will get the benefit of depreciation. We'll get the benefit of depreciation. Depreciation is a tax shield expense, so we'll get the benefit of depreciation. So I will merge all these numbers and calculate the incremental CFAT. So student will write along with me. Come on. Calculation of incremental CFAT. 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 Is my voice audible now clearly? Calculation of incremental CFAT. Right hand side, two columns, $million, $million. Write down first point A, incremental sales revenue. Incremental sales revenue. So you have to think now, what will be incremental sales revenue? Now you will be selling 5 million units if you undertake this project. If you do not undertake this project, you will be selling in future 1.5 million units. So your quantity sold will increase by 3.5 million units multiplied by the rate. So write down the calculation. Write down the calculation, 5 million minus 1.5 million into rate per unit 90. Come on, answer. Come on, answer. How much is that? That comes to 315. That comes to 315. Next point, less incremental cost. Cost will also go up because quantity has gone up. So the cost will go up. First write down variable cost. Now we are going to incur 5 million quantity into $30, and if I don't undertake the project, then I will incur 1.5 million unit into $50. So the difference will be my increase in variable cost. Difference is increase in variable cost 75, increase in fixed cost. Now 30. Earlier it was not there, 0. 30 minus 0. 30 minus 0. 30. Depreciation. 490 divided by 5 years. 98. So these are my incremental cost. Take the total in the outer column. Take the total in the outer column 203. Take the total in the outer column 203. Incremental revenue minus incremental cost is incremental PBT. So that is equal to A minus B, 112. Come on. Please reply now. Incremental PAT. Tax rate is 35%. So PAT will be 65%. Tax rate is 35, PAT will be 65% of 112. So take PBT into 65%. PBT into 65% is how much? 72.8. So PAT plus depreciation. If I add PAT plus depreciation, what do I get? If I add PAT plus depreciation, what do I get? Yes, reply. Mr. Yogesh, what is the answer? PAT plus depreciation. You will get incremental CFAT. You will get incremental CFAT. And that is point number D plus point number B3. Point number D plus point number B3. So how much is the answer now? 170.80. This I will require for NPV calculation. So next step number 2, calculation of incremental NPV. Calculation of incremental NPV. Draw this format: year, particular, cash flow, PV factor at 12% and PV. Usual format. Come on student. First, year 0. Cost of the plant and machinery. Cost of the plant and machinery 490 given in the problem. Year 0, incremental working capital. Important. Chance of mistake here. If you undertake this project, you will require a working capital of 60. If you continue with your existing project, there is already an investment of 25 million in working capital. So to undertake this project, you will have to put 35 million USD more today. So that is 35. That is 35. Year 1-5 write down. Incremental CFAT. Go to previous step 1. Check the answer. How much was that? It was 170.80. It was 170.80. Take the total of the PV factor given in the question, 3.6048. Multiply the two. The PV of CFAT is 615. Year 5 we have to write recovery of working capital. Recovery of working capital. Same what you've written here, 35. You write here in recovery also. Factor is given in the question book. RTP May 2023 SFM. RTP May 2023. Those who have joined late, you can download from our website vino.in this RTP with solution. Multiply NPV. Take the total of this last column. Good student will give me the answer first and fast. What is NPV? Last column total. Come on. 110.5588. 110.5588. Positive or negative? Positive. So the advice write down. The proposal should be accepted as NPV is positive. The proposal should be accepted as NPV is positive. The proposal should be accepted as NPV is positive. This way you will write the answer in the exam. Complete answer in detail, line by line, with all calculations presented, with final conclusion also, then you will get the full marks. Okay. In this question, one figure which we have not considered is allocated fixed cost. Allocated fixed cost is not relevant. You can mention here allocated fixed cost $3 million is not relevant because it will not affect cash flow. It will not affect cash flow. There is no incremental cash flow involved because of this. Now next, very easy question and repeated in the exam also. Question number 11. P Limited, a dealer, quotes all in cost. All in cost means all charges included. Brokerage, commission, administration, that is called all in cost. All charges included. Nothing will be charged over and above this. All in cost for a generic swap. Generic swap means swap of fixed versus floating rate. One party will pay fixed rate, one party will pay floating rate. That is generic swap at 6% against 6-month LIBOR flat. So what is the deal? That 6% fixed rate sorry, will be swapped against LIBOR for a notional principal amount of 8 lakh. This is the notional principal. This is required for calculating interest. This is required for calculating the interest. Calculate semi-annual fixed payment. Semi-annual fixed payment means how much the fixed rate payer will pay after 6 months. So the answer is 8 lakh into 6% into 180 divided by 360. That we will write the calculation later. Next point, find the first floating rate payment for one above if the 6-month period from the effective date of swap to the settlement date comprises 181 days. So when you are calculating floating rate payment, it is based on actual number of days and that the corresponding LIBOR was 5%. So here we will take 8 lakh into 5% into 181 days and divide by 365. In the question number 2 above, if the settlement is on net basis, we will take 360 here, not 365. Settlement is on net basis means only the difference will be received or paid. Settlement on net basis means the difference will be received or paid. How much the fixed rate payer would pay to the floating rate? This is my fixed rate payment. This is my floating rate payment. Difference between these two answers is your third answer. There is a note. Generic swap is based on 30 divided by 360 means month is equal to 30 days and year is equal to 360 days. When you are calculating fixed rate payment, we follow this convention. 1 month is equal to 30 days. But when we are calculating floating rate payment, we take actual number of days. When we are calculating floating rate payment, we take actual number of days, and that is why the question paper setter has given you actual number of days in case of floating rate. So please note down First answer part 1. Answer of part 1, semi-annual fixed payment. In the exam, first write formula, then write numbers, then write answer. Write down notional principal amount into all-in cost into period. 8 lakh into 6% into 180 divided by 360 into 180 divided by 360. So that is equal to 24,000 rupees. The fixed rate payer will pay 24,000 rupees. Fixed rate payer will pay 24,000. Now the question is how much the floating rate payer will pay. Write answer part 2. Floating rate payment. Floating rate payment. Notional principal into LIBOR into days divided by 360. Notional principal is 8 lakh into LIBOR is 5% into here will take actual days 181 divided by 360. So please reply. So that comes to 20,111. Answer of part 3. What is the net amount payable by the fixed rate payer? So just take the difference of the two parts. Fixed rate payer has to pay 24,000 and will receive 20,111. Therefore, the fixed rate payer has to pay a net amount of 3889. Net amount of 3889. That was the answer of this highly repeat question. Very easy. Question number 12 now. Question number 12. Again, highly repeated question. Highly repeated question. Excellent Limited reported a profit of rupees 154 lakh after 30% tax. So PAT is 154 for the year 1920. So this is the previous year PAT. An analyst of the accounts revealed that there is an extraordinary loss of 20 lakh and income included extraordinary income of 16 lakh. So first you will convert PAT into PBT. How do you convert PAT into PBT? You will take PAT divided by 1 minus tax rate 30%, means divided by 70%. PAT is 70% of PBT. To get PBT divided by 70%, so that will come to how much? That will come to 220. Now when you are doing business valuation, this is a question on business valuation, we have to consider normal income, normal operating profit. We should not consider abnormal item, extraordinary item. So what will you do? If there is an extraordinary loss, you add back, and if there is any extraordinary income, you deduct. That will give you normal profit before tax earned by this company in the last year. So normal profit will come to 224. So assuming that this 224 will continue, plus what happens next? The existing operation except for extraordinary item are expected to continue in future. This 224 will continue in future. In addition, the result of the launch of a new product are expected to be as follows. So they have added one more project in their business. What will be the effect of that business? Sales will increase by 140, material cost, labor cost, fixed cost. So this will generate an additional profit of 140 minus 40 minus 24 minus 20, 56. So my total profit will become 224 plus 56, which is 280. This will be the profit before tax in future. And then you will convert into profit after tax in future by deducting 30%. So after you deduct 30%, this will be 196. So this is called future maintainable profit after tax. This is called future maintainable profit after tax. From this business, 196 can be earned in future. Calculate the value of the business given that the capitalization rate is 14%. That is the required rate of return. So 196 divided by 14% will give you the value of the business, which comes to 1400 lakh rupees. Okay, so the first answer will be 1400 lakh. Second question, this is first question, this is second question. Determine the market price per equity share. Valuation of share now. With Excellent Limited share capital being comprised of 2 lakh at 13% preference share of 100 each and 100 lakh equity share of 10 each, and the P ratio being 12 times. Ignore corporate dividend tax. So if you look at this question, we have already computed 196 future maintainable profit after tax minus preference dividend will give you earning available to equity shareholder, divide by number of equity share will give you EPS, and EPS multiplied by P ratio. EPS into P ratio, come on, what is EPS into P ratio known as? Because they have given P ratio, it means the intention of the question is the student should use P multiple to solve the answer. Is it right? So almost answer I have written, but in the exam you need to present it nicely. Presentation is very important. So please write down, those who are writing along with me in the notebook. Reference is RTP, May 2023, question number 12, SFM. Calculation of business value. Calculation of business value. Right hand side rupees in lakhs. Right hand side rupees in lakhs. You are given existing PAT. You are given existing PAT of 154. You convert into PBT by dividing by 70%. So 154 divided by 70%. Profit before tax right now. Profit before tax right now. Then write down point number B. You will deduct extraordinary income 16. Deduct extraordinary income 16. Add extraordinary losses 20. Add extraordinary losses 20. So this will give you existing normal PBT. This will give you existing normal PBT. This is coming to how much? Calculate and tell me. 224. Then you write down point number E, profit from new product. Profit from new product. Under that write down sales 140. Sales 140. Material 40 in bracket. These are cost. Labor 24 in bracket. Fixed cost 20 in bracket. So existing profit will continue. the new product will generate additional profit, so my profit would increase in future by 56. Valuation is a function of future profit. A person pays for a business today because he will enjoy the future profit. Hence, we have to check what will be the profit the company would generate in future. Point number F, write down projected PBT, D plus E, come on, 280. Projected PAT, projected PBT into 70%. Projected PBT 280 into 70%. 30% deduction of tax 196. So this much profit they will earn in future. And what is the capitalization rate? Means required rate of return from such business. Investors' required rate of return called capitalization rate is 14%. So therefore value of business 196 divided by 14%. So investor will be willing to pay for such business as a whole 1400. Investor will pay for such business 1400. Now there is another question. What is the price of the equity share? So that you write down. And because they have given the P ratio also, one of the methods of valuation is P multiple. That is earnings multiplied by P ratio. So write down. Step 2. We'll use P model, P multiple approach for this answer. So calculation of market value of equity share, right hand side amount. First point A, projected PAT. Projected PAT is 196, already calculated in step 1. Projected PAT step 1 196 less preference dividend rupees in lakh, less preference dividend 2 lakh share in 200 into 13%. So that comes to 26 lakh. So now what I'll get is called earning available to equity shareholder. Earning available to equity shareholder. Earning available to equity shareholder 170 lakhs. Number of equity shares. Number of equity share in lakhs. Number of equity share in lakhs is given in the problem, 100 lakhs. Number of equity share is 100 lakh. So EPS would be 170 divided by 100. EPS would be 170 divided by 100. So that is 1.70. In this question, P ratio is given 12 times. P ratio is given 12 times. So if I go by P multiple approach, the market price per share MPS would be P ratio into EPS. So it comes to 20.40, 20.40. Please check the answer, 20.40. So this was a very, very simple question on business valuation, which they have asked so many times in the exam. Now we'll come to question number 13. One more question we will take on mergers and acquisition now. This question was also asked in the past exam. But good question. Similar question they have asked in the recent exams also. So let us practice this question number 13. Keep the notebook ready. Keep the RTP May 2023 in front of you. If you don't have RTP, you can download from our website vino.in from the free resource section. Come on. The following information is provided relating to acquiring company Efficient Limited and the target company Healthy Limited. So the company acquiring company is efficient and the target company is called healthy. Number of share face value is 10 rupees, 20 lakh share, 15 lakh share. Then they have given market capitalization. Market capitalization means market value of the entire firm. Number of shares into MPS is called market capitalization. So if market capitalization is 800, number of shares are 20, you can find out the MPS from this. So some missing information is there. Good student will be able to read between the lines. So between the lines MPS is there. P ratio is 10 and 5. So if MPS is known, P ratio is known, the student can find out EPS also. MPS divided by P ratio will give you EPS. EPS multiplied by number of share will give you total earning. So these are some missing figure which you have to find first. Reserve and surplus is given. Promoter holding in number of share is given. Shares held by promoter. Board of directors of both the company have decided to give a fair deal to shareholders and accordingly the swap ratio, for swap ratio means exchange ratio, the weights are decided as 45%, 20% and 35% respectively for earning, book value and market price of share. So this is called weighted average swap ratio. Instead of one factor, they have considered three factors in deciding the swap ratio. One is earning per share, weight will be 45%, book value per share, weight will be 20%, and market price where the weight is 35%. So we'll have to find out what will be swap ratio according to these three variables and then apply the weights, calculate weighted average swap ratio. That is my first question also. Calculate the swap ratio, and after calculating swap ratio, calculate promoter shareholding percentage after acquisition. If you get this answer right, then you will get other answers right also. What is the EPS after acquisition? What is the expected market price per share and market capitalization after acquisition, assuming P ratio remains unchanged? Assuming P ratio remains unchanged means P ratio will remain 10. For solving third question, P ratio will remain 10. And what is free float market capitalization of the merged firm? Free float market capitalization means market value of shares held by non-promoter. Market value of shares held by non-promoter. Market value of shares held by non-promoter is called free float market capitalization. In India, on the stock exchange, the weightage is given nowadays on the basis of free float market capitalization because that is available for trading purpose. Shares held by promoters are not available for trading purpose. Okay, so now the student will solve very easy question we have done in class also. One more time, this question was there in our class notes also. First step 1, calculation of EPS, BVPS MPS and total earning, and total earning, and total earning. Right hand side two columns, healthy limited, efficient limited, healthy limited, efficient limited, healthy limited, efficient limited and healthy limited. First you start with market capitalization. The objective is to find out first MPS. From MPS we'll find EPS. From EPS we'll find total earning. Point number A, market capitalization rupees in lakhs. Question should be in front of you. 800 and 1200. Point number B, number of shares. Question in front of you, 20 and 15. MPS will be A divided by B. MPS will be A divided by B. 40 rupees, 80 rupees. P ratio in times given. P ratio in times given. Which is given to you 10 and 5. So now the student will calculate EPS and tell me. Yes, please reply. What is EPS? 4 and 16. 40 by 10, 80 by 5. This is so basic that I am assuming everybody knows it. Total earning. This is EPS. This is number of share. So I will write down B into E, rupees in lakhs. Multiply 20 into 480, 15 into 16, 15 into 16, 240. Now I have got EPS, I have got MPS, I have got total earning. So my next task is BVPS. For that I will take share capital plus reserve divide by number of share. So share capital is given in rupees in lakhs. 20 lakhs share into 10 rupees, 200. 15 lakhs share into 10 rupees, 150. Reserves given. Reserves in rupees in lakhs given 400 and 273. So shareholder fund G plus H, shareholder fund G plus H, 600, 423, and last point J, write down book value per share in rupees. Book value per share in rupees 600 divide by number of shares, 600 divided by 20, that will give you 30. 423 divided by 15, 423 divided by 15 will give you 28.20, 28.20. Any query on this? So this is basic working note. Now I am going to use this for my next answer. Next answer is calculation of swap ratio. Calculation of swap ratio. Step 2 is calculation of swap ratio. I will give you a format first. Calculation of swap ratio. First column write down basis. Second column write ratio. Under ratio write down base of healthy limited divide by base of efficient limited. Target company upon acquiring company. Target company upon acquiring company. Third column write weight. Fourth column weight into ratio. Fourth column weight into ratio. Fourth column weight into ratio. After that we'll solve one by one. First we'll calculate swap ratio based on EPS. If you look at the step 1, what was the EPS of healthy limited? 16, and EPS of efficient was 4. So going by EPS, the share exchange ratio will be 16 divided by 4. 16 divided by 4. 16 divided by 4 is equal to 4. The weightage to EPS is 45%. So I will write 0.45 and then multiply. It comes to 1.8. Second factor is book value per share. Look at your step 1. Book value per share is in the last line of your previous step 1. Healthy is 28.20. Efficient is 30. 28.20 divided by 30 is 0.94. 0.94. The weightage to BVPS is 0.20. Take your calculator. 0.20 into 0.94. So the weight into ratio will be 0.188. What is the third basis? MPS. Look at your step 1, third line. MPS of healthy is 80. Divide by MPS of efficient, third line of step 1, 40. That is 2. Weightage is 0.35. Multiply 2 into 0.35. Yes, multiply. Come on. 0.70. Total of this last column is your swap ratio. So that comes to 2.688. 2.688. 2.688. So write down note. Swap ratio is 2.688 shares in efficient limited for each share in healthy limited. 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 Now the next question is, what is promoters holding percentage after acquisition? So write down step 3. Promoters holding percentage after acquisition. So I need to find out two things. Total number of share and shares held by promoters after acquisition. So number of share held by promoter divided by total will give you percentage. Very easy question. Point number A. Existing shares of efficient. Efficient is acquiring healthy. So efficient limited already has 20 lakh share plus shares issued to healthy limited. Shares issued to healthy limited. There are 15 lakh shares in healthy limited books. This is the swap ratio. So they will get 15 into 2.688, which is 40.32 lakh share. Point C, total number of shares after acquisition, A plus B. Total number of share after acquisition will be 60.32. 60.32. Point D, write down shares held by promoter. Shares held by promoter. So promoter of efficient limited are already holding certain shares. Look at the question, fifth line in table. They are already holding 8.65 lakh share and plus promoters of Healthy Limited will also get shares in Efficient Limited. They are holding in Healthy Limited 9 lakh share, and they will get 9 lakh into 2.688. So promoters of Healthy Limited will be holding now 9 into 2.688. That comes to 24.192 lakhs. If you add these two, this is the share held by the promoters. So total comes to 32.842. 32.842 divided by 60.32 will give you promoters holding in percentage. Very easy. Presentation is very important. This way you have to present in the exam. Everything must be clearly written. Every calculation must be shown. So the answer for this would be D by C, 54.45%. 54.45% means for free float calculation, you will have to take 100 minus 54.45%. That will be my last step, free float. Just keep this number in mind. Now my next question is, what is the post-merger EPS? What is the post-merger market capitalization, post-merger MPS, and free float? So all in one answer only. Write down. All these questions can be answered in one table, so we'll save time. First, write down step number 4, heading post-merger EPS, post-merger MPS, post-merger market capitalization, and post-merger free float market capitalization, and post-merger free float market capitalization. Under that, write down A, total earning after merger. There is no synergy benefit. So total earning will be sum of the earnings of the two companies. Step 1, earnings of one company is 80 lakh, earning of the second company is 240 lakh. So assuming no synergy because nothing is given, we'll take 320. Total number of shares. Go to step 2. Step 3. Previous step. Step 3, total number of shares you have got it. 60.32. Is it there? So now the student will tell me what is post-merger EPS. I am waiting for your answer. Post-merger EPS. A by B. A by B in rupees. A by B in rupees. That comes to 5.305. Post-merger P ratio. The problem says post-merger P ratio will not change. It will be same what it was before. So that is 10 times. Therefore, post-merger MPS. Therefore, post-merger MPS. C into D. Just multiply in rupees 53.05. Rupees 53.05. Rupees 53.05. Now this is post-merger or market price of one share, and this is total number of shares. So if you multiply these two, you will get post-merger market capitalization. So kindly multiply. A very easy question. But you have to practice in advance. This comes to 3199.976. 3199.976. Now the next question is, last part of this answer is free float market capitalization. So for that, this is my total market capitalization. 100 minus 54.45% is non-promoter shareholding. So kindly do this calculation yourself and write here, and that will be your free float market capitalization. Yes, try. Please try. So that comes to rupees in lakhs 1457.589. 1457.589. 1457.589. So this is the answer of this wonderful RTP. Dear students, now the exams are just about 1 month away. How to prepare in the last 25 days to 1 month? That is a very important question which every student of CA course must know. In the last 1 month, do not try anything new. Whatever you have studied till now, just revise that. Do not try new study material of some other class of your friends. So whatever you have studied in the class, if you have joined any class, revise those notes now. Revise your own notes if you have prepared your own notes. Just quickly go through the RTPs of the May 2023 exam, and if you find that there are some new question or some amendments mentioned there, do that. In the last 25 days, it is a time to get yourself stress free. I know it is very easy to say but very difficult to observe. But 1 month, trust me, if you can just keep your head calm, cool, you will surely be able to perform well in the exam. And if you take stress during this period, then it can affect your performance in the exam. This is the time to consolidate whatever you have studied. Trust me, you have prepared well, you are capable of appearing for this exam and get good marks, but the only thing is that you should not get stressed. Stress can harm you. Okay, so sleep nicely in the sense, don't sleep 10 to 12 hours, but 5 to 6 hours of sleep will be good enough. Some students don't sleep only for days, or they just sleep for 2-3 hours. That is not going to help you. You may not be able to recollect what you have studied in the last day of the exam or in the last minute of the exam. So therefore, whatever you have studied, you need to keep it in your mind, and you should be able to extract it in the exam and write your answer. Do not talk too much with your friends, because every student is different. Every student has a different skill set. Everybody has a different intellectual capacity. So some of your friends might confuse you. They might say, oh, have you studied this? Have you studied that? And then you will feel that I have not studied this and that, so I'm not going to appear. Have confidence. You have done very good, and you can really do in the exam. So dear student, so my suggestion to you would be, revise only whatever you have studied. Sleep sufficient number of hours to keep yourself healthy. Do not take stress. Do not talk too much. If you want, you can appear in certain test series so that you can check your level of preparation. Do not attend marathon classes in this last minute. It will not help you. What you study yourself is going to help you only. So with these words, I wish you all the best for your exam. Thank you.